during the last period of massive innovation. It was in the late 1800s, early 1900s, the 50 years to 1929, the yield curve was inverted more than half of the time, with the steepest inversions taking place during periods of the most rapid growth. The innovations back then, of course, were electricity, telephone, and the internal combustion engine. We had until that point never seen such a period of innovation. So we believe, and have believed for some time, that the yield curve will continue to flatten because of this natural deflationary, but good deflationary force at work in the economy, enabled by technology, and that the short end of the curve will actually go up, especially when these trade tensions are settled. The short end of the curve will go up relative to the long end, and maybe the entire curve will shift up. And we would not be surprised to see an inverted yield curve and no recession. So with that, I've got my slides, and let's go. Innovation platforms. What do we consider an innovation platform? We center our research on something called Wright's Law. Wright's Law is, and you'll get this sense of exponential growth here, Wright's Law says that for every cumulative doubling in units produced, costs decline at a consistent rate. Mr. Wright derived this formula during the early days of airplane manufacturing. And he noticed for every cumulative doubling in the number of airplanes produced, costs declined at a consistent rate. When costs decline at a consistent rate, they tend to, prices come down and unleash waves of demand. That's what we're talking about when we talk about exponential growth. You can see in the middle panel here, that's electricity, the start of electricity, and you can see how quickly it spread throughout the manufacturing sector in the United States. And then the third characteristic, so innovation platforms are characterized by declining cost curves, they cut across economic sectors, cut across the world, and the third characteristic is they spawn more innovation. So the innovation platforms that are evolving today, you can see on the right there. We are publishing a paper this week on this chart. And what we're trying to communicate here is we have never been in a period of innovation like we are now. If we were measuring this on the Richter scale in terms of impact on the global economy, this would be a 9 compared to maybe a 5 or 6 in the late 1800s, early 1900s. So you can see you have to look back that far to the late 1800s, early 1900s to see multiple innovation platforms evolving at the same time. So back then, as I mentioned, telephone, electricity, internal combustion engine. Today, we have blockchain technology, deep learning, robotics, energy storage, and artificial intelligence. These innovation platforms are going to impact every sector and are traveling around the world, as Amin and Will set us up to understand, very, very quickly. So they're going to transform every company and every industry. Here, you can see the 5 innovation platforms are the biggest bubbles on this chart. But there are other technologies. Each of the 5 is going to be multiple $1 trillion of market cap, we believe, in the financial markets during the next 5 to 10 years. You can see other technologies evolving with them. And you can see the one specific to fintech, which is what this conference is mostly about. So you can see mobile value transfer devices, artificial intelligence in the cloud, and blockchain technology. So 2 of the big 5 are at work in the fintech space. So you can see that modern financial industry evolved over roughly 1,000 years. So in the 1100s, we had the first foreign exchange contract. In the 1600s, the first stock exchange. Not until Amazon did its one-click payment system did the modern age, we think, start to take off. So that was in 1999. And then you had PayPal's email payment system, and then you had Alipay's app payment system, and you see the explosion in China's mobile payment volume. So in 2017, when I first saw the number 9 trillion, it was 8.6 trillion, that China was reporting for its mobile payment volume, I just didn't believe it. I didn't believe it because its economy was $11 trillion, and the consumer was 35–40% of that. And so I was thinking very narrowly and incorrectly, and shame on me because I have an economics background. What we're seeing here, look at this, $1 trillion in 2014 in China's mobile payments to $26 trillion. That's only 4 years. That was 2018. Talk about exponential growth. It's 2 times their economy, and China accounts for more than 90% of all mobile payments globally. They have run with this, and if you go into China, into tier 3, tier 4 cities, you will see merchants in huts using only WeChat Pay. They don't want cash. They're afraid of counterfeit cash. And these are 70 and 80-year-olds. You do not see that certainly not in the United States and the developed world. They didn't have the financial rails to begin with. They didn't have a deeply entrenched banking system. Most people in China were unbanked. Now they have a bank in their pocket. So, and you can see 2 times GDP. How can that be? Well, it's because of the velocity of money. In the United States, the velocity of money is 5. So 5 times our GDP would be $100 trillion. 5 times China's today would be 65 trillion, but they are soon going to pass the United States. So we are talking about, and they are showing the way to the rest of the world. Africa, same situation. You don't have the financial rails entrenched like we do. We have kind of good enough and a lot of inertia, but you can run with this. You can run with this and leapfrog the developed world. Here are some of the other reasons. This incorporates the velocity concept. So GDP just measures value added at each stage of processing, where each transaction captures all stages of processing, of course, in fintech. And then we've got gifting. Red envelope day in China is huge. P2P transfers, tipping. So all measure of activity that is not captured by GDP. So here we are for the global economy is roughly $85 trillion. Multiply that by 5, so $500 trillion in activity we believe fintech will touch during the next 5 to 10 years. You can see the digital companies that have spawned this movement. Actually, Amazon and Alibaba had to really start this digital wave off with the one-click payment system and app-based payments. And now you're seeing many other more pure-play fintech companies move into the game and turbocharge it. Square with Square Cash, the digital wallet, which actually can buy and sell Bitcoin with no transaction fees. Wirecard in Germany, PayPal in the United States. Shopify is enabling a lot of the Chinese goods it's the e-commerce platform for many American companies so that they can accept Chinese goods. So now, millennials are accelerating the fintech revolution. And here you can see we're hearkening back. Well, first of all, this is Venmo. if you don't know what Venmo is, it's peer-to-peer. You can, millennials will go to a restaurant and they'll all share a meal, and then on Venmo, they'll just Venmo each other for whoever pays, the others will Venmo their payment. And it's very social. You can see who's doing what. There are some privacy settings, but most people just are able to see, well, who paid me back and who didn't, and there's a little bit of peer pressure there. 40% plus use Venmo more than once per day. Now that's the millennials. You can see other age groups are beginning to catch on, but they're way behind. And we go back to social media, the adoption of social media. Back in 2006, millennials were moving on to social media. At about 40% of them were involved. And you can see here again, much lower in the older age groups. Actually, if you go back, you can see that the older age groups are adopting fintech a little faster relative to millennials than they did social media. And part of the reason for that is, I know in my own case, my children want me to use Venmo. They want me to be on Venmo because guess what? It's a way for me to get money to them really quickly. Whereas with social media, they did not want me to be on Facebook or any other place. So I think fintech is taking off for that reason a little faster. You can see 12 years later how much every age group was participating in social media, and we do think the same thing is going to be true of fintech, although perhaps much faster. You can see that the unbanked, there are about 1.7 billion. I'm sure you've heard that number, and we'll hear it many times at this conference. But more than 1 billion of the unbanked around the world have a mobile phone, and therefore they will, and they are beginning to carry their banks around with them in their pockets or their purses. Even in the United States, 20 million people out of roughly 330 million are unbanked. That is about the same size as the number of US customers that Citibank has. So it's a lot of people and a huge unmet need out there. 1.4 trillion cash transactions per day in the world, so lots of room for fintech to move in and take over. So I don't have to go through a lot of the technology. Amin did such a good job on that. But we do think digital wallets are going to become ubiquitous. We are looking, as an investor, we are looking for the companies that are going to win in this space. Those are going to be huge investment opportunities because it's going to be winner take most. In the United States, the Square Cash App has a really good opportunity there. And Venmo does as well. So you can see it's not the traditional banks that are in the lead here. Many of the banks, I think in the last few years, thought that Square and Venmo were nipping at their heels, you know, kind of a nuisance, really millennials only and so forth. But you can see what has happened here. If you look at the number of digital customers, now this is just for the US because this is the data that's easy to get. If you look at the number of US customer digital asset accounts, you'll find that Venmo is already number 2, right behind JP Morgan. And Square's Cash App is number 6. What you don't see in this chart is that both of them will probably, they're growing so much faster, Square Cash at roughly 80% and Venmo at roughly 40%, that they are going to surpass the banks in terms of number of digital accounts very, very soon, within the next few years. At the same time this is going on, another phenomenon is taking place, and it's actually being led by Goldman Sachs. Goldman Sachs launched an online bank and savings service, no bricks and mortar, and they are, while Square App Square, Cash App, and Venmo might have been nipping at their heels from the bank's point of view, Marcus is coming right at the bank's head. Marcus is offering interest rates of 2.25% for deposit accounts, compared to 50 basis points or less for traditional accounts. How can they do this? It's no bricks and mortar compared to the traditional banks, so their expenses are much lower. And just to give you a sense how quickly it's spreading, the Marcus phenomenon, first of all, Goldman Sachs is a great name, great brand, and my bookkeeper shifted my account, or some of my accounts, to Marcus automatically without even talking to me, because she knew I'd be okay with it, the brand name and so forth. So, you know, this is a real problem for the banks. Artificial intelligence. So we believe now, the reason we believe that artificial intelligence is ready for prime time, you know, we've heard about it for years and years, and it's been great for science fiction. But until recently, until Amazon and Netflix started making suggestions for what we might like to buy or watch, and Apple launched facial recognition, until those goods and services came about, it didn't really affect our lives. So why do we think artificial intelligence is ready for prime time now? It's ready because we've taken the human programmer out of a large part of the equation. So we do a lot of work on autonomous vehicles, for example. And in autonomous vehicles, we know that a programmer cannot possibly imagine every permutation that might happen in terms of intersections and lane changing and so forth. Just not possible. However, you unleash big data and iterative algorithms and supercomputing power and just push those together. This is very hard for a human being to accept, but they will come up with better answers and can imagine many more permutations once we train them. And we just need to train them with data and algorithms and supercomputing power to reach an outcome that a human being does set. I'd like to get from point A to point B safely and as quickly as possible. So as we have analyzed the opportunity for artificial intelligence, we took a look back at the former computing waves. So the PC wave was the first one. That's responsible right now for about $4 trillion in market cap. Then over the following 20 years to 2018, another 10 billion we can now attribute to the internet. And we believe over the next 20 years, that there will be $30 trillion worth of market cap out of there created because of artificial intelligence, compared to 1.5 trillion right now. So that's a 14% compound annual growth rate. I believe that is way too conservative, because all we're doing is assuming that artificial intelligence has the same amount of impact on the market as the internet did globally. We believe that artificial intelligence is going to impact every line item of the income statement, and any business leader not trying to figure out, you're going to hear a lot about AI here, not trying to figure out how it applies to his or her P&L line is going to be in competitive trouble. So here, of course, are the ways, and again, I won't dwell on these, but Amin did in his videos show how biometric is going to become very, very important in terms of preventing fraud and analyzing credit risk. So we're pretty excited about what artificial intelligence is going to continue to do. To give you a sense of what AI is already doing, you can see on the right-hand side traditional lenders versus Square. Square, in case you're not familiar with it, is if you've ever seen a mobile phone, you'll see, I don't know if it's in this country yet, I don't think so, but they'll be able to put a little square on top of the mobile phone so that we can swipe our cards. And you've got merchants running businesses on their mobile phone with Square's apps. And because Square is able to monitor every transaction every minute of the day of these businesses, it has so many more data points than a traditional lender. When Square says to a merchant, you know, it looks like you might need a working capital loan, or you might want to invest in some equipment. So it's starting to help small businesses build their businesses because it has all of this data and is able to understand the kinds of risks it's dealing with. But look at the difference between Square and traditional lender. It has 300,000 data points to make decisions on, whereas a traditional lender has 800. It's able to make these decisions in 7 minutes, maybe not 2 seconds, like Amin said for Alipay, but 7 minutes compared to 60 to 90 days for a traditional lender in the world of small business is a world of difference. And you can see the difference between the kinds of data they're dealing with. Continuous real-time data for Square and discontinuous and discrete for the traditional lender. So there's no competition here. There's just no competition. And then finally, Bitcoin. Why is Bitcoin ready for prime time? Bitcoin is ready for prime time because it's serving a huge unmet need. Now, in the US, when we were the first asset manager, the first public asset manager in, I think, the world to gain exposure to Bitcoin through the Bitcoin Investment Trust in 2015 when it was at $250. As you know, today I think it's close to $9,000, having round trip from 20,000 to 3. So we're still in very early days. But what we're already beginning to see is it serves for low-cost remittances and for faster trade settlements. I've always wondered, as an investor, I can trade something in a millisecond and maybe thousands of milliseconds, but it still takes 2 days to settle. That doesn't make any sense. There are too many toll collectors, too many middlemen along the way. That is going to change. Australia is going to launch its blockchain solution, I think, in a year or so. It's quite delayed. But we do believe that is the way these markets are going to go. As far as remittances, we are already seeing solutions, I know, from South Korea to the Philippines. The remittance market is a $600 billion market, even though Western Union and others charge 8%, and in some cases, I've heard in Nigeria, for example, 25% to send money back home. So it's ridiculously expensive. Ultimately, what we think the Bitcoin blockchain is going to do specifically is allow for much cheaper. It's money over IP. Think voice over IP. I don't know if many of you remember, but technology futurists were saying, when my parents lived in California and I lived in New York, voice is going to be free. And I was thinking, yeah, bring it on, because it was very expensive to call. Today, I have 3 children. They're in their 20s. They cannot believe I ever paid for a phone call, right? Sounds crazy, but that was voice over IP. This is money over IP. It's going to become the free transmission of money over IP. And we do think the Bitcoin blockchain is the most secure out there and will be the biggest enabler for this. Ready for prime time, the Bitcoin blockchain last year accommodated $1.3 trillion in transactions. Now, this is not trading activity. This is transactions. The Bitcoin blockchain is completely transparent. So you can follow an IP address and figure out the transactions. 1.3 trillion is more than twice PayPal's network. So and PayPal is very well developed in the United States, and it is spreading internationally. So how did this happen? In the United States, many investors don't believe this number. And it's because we're not seeing this in the US. The huge unmet need is not in the US, at least not yet. It's in Venezuela, where those people, the people in that country, are losing their purchasing power. It's collapsing around them. Terrible monetary policy, terrible fiscal policy, and that's where you're seeing it around the world. We've done studies on confiscation of wealth. I think if the princes in Saudi Arabia had understood what was going to happen to them, they might have had a private key number in their head and had some assets on the Bitcoin blockchain, because those would not have been confiscated. No one would have known about them. So if we've done lots of studies, and just that application alone, confiscation of wealth, if you take the highest net wealth individuals in the world and you make the assumption that they're trying to hedge against a 5% chance that their wealth will be confiscated, that alone, and I'm talking about not that many people in the world, that alone would be a $2.7 trillion opportunity for a Bitcoin blockchain. The other huge unmet need is in countries where cross-border trading, and I know this is true in Africa, where cross-border trading is very, very expensive just because of the currency conversions. So if you look at the average transaction size in that $1.3 trillion of transactions, it's $15,000. And some will quip, oh yeah, that's drug money. The drug money is not on the Bitcoin blockchain anymore because it's too transparent. It's going more to the dark chains, Zcash perhaps, but not to Bitcoin. No, these we believe are business-to-business transactions. It's B2B. And we're pretty excited about what the Bitcoin blockchain future holds. We do believe there will only be a few cryptocurrencies. Now, right now, there are more than 2,000 crypto assets. We believe there will only be 2, 3, or 4 cryptocurrencies, much like we see now. The reserve currency today in the world is the dollar. We know now from the crash that we saw from $20,000 to $3,000 that Bitcoin's market share of the crypto asset ecosystem went from the low 30s to up to now 60. That is what happens during a flight to safety. The world reverts to the reserve currency. The reserve currency of the crypto asset ecosystem, we believe, is Bitcoin. And there will be a few more currencies, just like there are the yuan, the euro, the yen. So we do believe, and we're looking for those, but we also believe that most of the 2,000 crypto assets in the world today will be pretty worthless, because the velocity, it's back to velocity, an economic concept here. The velocity of many of them is going to be enormous, because those who are working in the crypto asset ecosystem are always going to default to the reserve currency, and we do think that will be Bitcoin. So with that, I think I might have time for a question or so if we can allow that here. Any questions? I don't know if this is a Q&A forum or not. Anyway, thank you. We're really excited about the future. We think the biggest undervaluation out there is in the public markets, innovation specifically, because what has happened since the tech and telecom crash and the 08-09 meltdown, there's been a shift to what investors perceive as safety. So there's been a lot of indexing and passive investing. Guess what? They are in harm's way, because those indexes are filling up with value traps. Value investors know this. They know their biggest risk is a value trap caused by innovation. Growth investors don't understand this yet. But if we're right, growth investors are holding right now a bunch of value traps, because the world that we are in is moving so blazingly fast, as you saw, and China is setting the pace in many ways, as you saw from that mobile payments chart. $1 to $26 trillion in 4 years. That's crazy. All right, thanks so much.